Okay, let's unpack this. You know that feeling when you're staring down a mountain of information, especially for something as critical as an advanced exam?
Oh, yeah.
It can feel overwhelming, like trying to find a specific needle in a haystack of knowledge,
Yeah.
and then needing to understand exactly what that needle is for, where it came from, and how it fits into the bigger picture.
hmm
But what if there was a shortcut to not just finding that needle, but truly mastering its context and application?
Well, that's precisely what we do here on the Deep Dive.
Exactly.
Precisely. Today, our mission is to cut through that information overload for you, the diligent learner. We're going to dive deep into 3 specialized areas of auditing that are absolutely crucial for anyone preparing for an advanced auditing exam. Standard on Auditing 800, 805, and 810.
Right, the 800 series.
Yep. These standards on auditing, or essays, deal with highly unique situations that auditors face, and understanding their specific considerations isn't just about memorizing rules.
No, it's more than that.
It's truly grasping their practical application to apply them effectively and accurately, especially in case-based scenarios you might see.
That's right. We've got a stack of essential sources, from the bare standards themselves to expert commentary and practical insights, to help you grasp the core concepts. We'll focus on the exact language and terminology you'll see in the exam, and crucially, how these concepts are applied in real-world and therefore exam-style scenarios.
Yeah, bridging that gap between theory and practice.
We'll even walk you through a detailed case study, just like you might face on test day, allowing you to connect the theory directly to practical application.
So what does this all mean for your preparation?
It means a clear, comprehensive review designed to help you not just understand, but deeply retain this material, turning complex guidance into actionable, exam-ready knowledge.
Okay, let's get started.
All right, let's kick off our comprehensive review of specialized audits by focusing on SA 800, Special Considerations Audits of Financial Statements Prepared in Accordance with Special Purpose Frameworks.
Right.
This standard is fundamental because it addresses situations where financial statements aren't created for just anyone or for the general public, but rather for a very specific audience or precisely defined purpose.
Exactly. When we talk about special purpose frameworks, or SPFs, we're referring to a financial reporting framework designed specifically to meet the financial information needs of specific users.
Okay, specific users.
This is a crucial distinction from a general purpose framework, or GPF, which aims to meet the common needs of a wide range of users, like general shareholders who need a broad overview of a company's financial health, or, the public seeking general transparency.
So a GPF is kind of the default for everyone.
Pretty much.
Yeah.
A GPF is designed for a broad audience with diverse needs, aiming for neutrality and comprehensiveness.
So if a GPF is like a general purpose map for everyone to navigate a city, showing main roads, landmarks, and general areas for widespread use, what would an SPF be in that analogy? How does that translate?
Okay, good analogy. An SPF, then, would be a highly detailed custom map just for, say, delivery drivers navigating specific routes, highlighting one-way streets, loading docks, and specific delivery times.
Ah, very specific.
It's tailored, very precise, and maybe only useful for that particular job or for those particular users. The key insight here is that an SPF isn't about giving a broad, neutral picture. It's about providing exactly the information needed by a specific group for a specific decision.
Even if it's not quite neutral.
Even if that means diverging from principles that would apply to general-purpose financial statements.
Okay. And crucially, SA 800 applies to the audit of a complete set of financial statements, but these statements are prepared under that special purpose framework.
That's a key point. It's the whole set.
This isn't about just auditing one part of the financial statements. It's the whole picture, just crafted for a niche purpose, which is what differentiates it from what we'll discuss later with SA 805.
Correct. SA 805 is different in that respect.
Yeah. So, given that SPFs are so tailored, what are some of the most common or perhaps surprising situations where auditors encounter these frameworks in practice? Can you give us a couple of examples that truly highlight their specificity?
Certainly. Our sources provide several excellent real-world examples. One common scenario is financial reporting provisions embedded within a specific contract.
Okay, like in a contract.
Yeah. Imagine a situation like C.A. Julie's assignment mentioned in the material, where a contract stipulates payments based on very particular parameters in exchange for services. The contract itself dictates how the financial information used for that specific payment calculation should be presented.
So the framework is literally written into the deal.
In that case, yes. This means the framework isn't a widely recognized accounting standard, but the specific terms negotiated between two parties.
Wow. Okay, what else?
Another compelling example could be a framework agreed upon by a vendor and purchaser for establishing the value of net assets at a sale date.
Right, like for a business sale.
Exactly. And this framework might, surprisingly, allow for very prudent estimates of allowances for uncollectible accounts receivable.
Very prudent. That doesn't sound very neutral, like you'd expect in standard accounting.
It doesn't. And you'd be right, especially compared to a general purpose framework, which emphasizes strict neutrality. But the core insight here is that an SPF can explicitly deviate from such neutrality to meet the specific needs of the contracting parties.
So the users want that prudence.
Maybe. For example, the purchaser might want a conservative estimate of collectibility to protect their investment, and the framework is designed to reflect that specific informational need, not necessarily a true and fair view for everyone.
That's a fascinating point. So the framework itself might include biases or specific viewpoints because that's what the users of that information actually want or need to see, rather than a purely neutral picture for everyone.
Exactly right. It really highlights the purpose aspect.
Okay. Any other examples?
Yeah. We also frequently see SPFs when financial reporting provisions are prescribed by a regulator for specific entities or industries.
Regulatory requirements.
Think about how certain nonprofits, public sector entities, or even very niche industries might have unique reporting requirements set by their governing bodies to ensure compliance with grants, specific laws, or industry-specific economic realities.
So tailored for regulatory oversight.
Precisely. Or, as our source highlights, agreements with venture capital firms for internal reporting. They might define a specific framework for how the company they've invested in should report to them, often focusing on key performance indicators or specific valuation metrics that align with their investment strategy. Very targeted reporting.
Makes sense. It's also important to note the scope limitation here, right? SA800 doesn't cover everything.
Correct. While SA800 covers all the crucial considerations for the acceptance, planning, performance, and reporting of the audit, it does not extend to expressing an opinion on the effectiveness of the entity's internal control.
Okay, so no opinion on controls under SA800.
That's a separate engagement if it's needed, and it's vital for auditors to understand this boundary.
So we've defined what an SPF is and why it matters for reporting. But before an auditor even starts to dig into the numbers, there's a critical first step: deciding whether to even take on this kind of engagement.
Absolutely. Acceptance is key.
What are those initial hurdles when considering accepting an SA800 engagement?
Well, the first and biggest hurdle is determining the acceptability of the financial reporting framework. This isn't a rubber stamp. It requires careful professional judgment.
It's not automatic.
No. The auditor must determine if the special purpose framework applied is acceptable in the given circumstances. This involves attaining a clear understanding of the purpose for which the financial statements are prepared and who the intended users are.
Purpose and users. Got it.
This fundamental understanding shapes the entire audit because the suitability of the framework is directly tied to those two factors. For instance, if financial statements are being prepared to determine a bonus pool based on a very specific contract-defined profit calculation.
You need to know that purpose.
Understanding that specific purpose and the specific recipients of the bonus is paramount.
And it's not just about what the auditor thinks is acceptable, right? Management has a role too.
Definitely. They also need to evaluate the steps management has taken to ensure the applicable SPF is acceptable in the given circumstances. Management has a responsibility here too, and the auditor needs to see how diligently they've discharged it.
So, checking management's homework on acceptability.
In a way, yes. And what's truly crucial here is that the acceptability of the framework is ultimately a matter of professional judgment.
Especially if it's not a standard framework.
Particularly true when the framework isn't a universally established standard, but encompasses provisions of a contract or sources other than established standards. It involves assessing if the framework exhibits attributes normally found in acceptable financial reporting frameworks, as per SA 210.
Like relevance, completeness.
Exactly. Relevance, completeness, neutrality, reliability, understandability, but within the context of its specific purpose.
Context is key.
So going back to our earlier example, if the contract allows for very prudent estimates for uncollectible accounts, the auditor must judge if, within the specific context of that contract and its intended users, such a provision is acceptable, even if it deviates from a general purpose framework's neutrality.
Requires deep understanding, then.
Deep understanding of the contract's intent, the user's very specific needs, and the risks if those needs are misrepresented.
Okay. Once the engagement is accepted, the planning and performing phases come into play. Here, the auditor needs to remember that even for these highly specialized audits, the fundamental rules of auditing still apply,
They do.
but with some very important adaptations.
Indeed. The auditor must comply with all relevant standards on auditing and ethical requirements, including independence, just as they would in a general-purpose financial statement audit. This is non-negotiable.
Can't skip the basics.
Never. While these are generally complied with in their entirety in exceptional circumstances, an auditor may judge it necessary to depart from a relevant requirement.
But that sounds risky.
It is, and it isn't taken lightly. It must be because alternative audit procedures achieve the aim of that requirement, and such a departure, along with the alternative procedures, must be properly documented.
Documentation is key.
You can't just decide to skip a step without a very good reason and a clear, auditable trail of how you achieve the same objective differently. This ensures the quality of the audit isn't compromised.
This sounds like a tightrope walk. You have to follow the rules, but also be flexible enough to deal with unique situations, all while maintaining rigorous documentation.
It is. It's a testament to the judgment involved.
What else in planning and performing?
Another key area, especially when the financial statements are prepared under a contract, is understanding significant interpretations.
Okay, significant interpretations of the contract.
Yes. The auditor must obtain an understanding of any significant interpretations management made of that contract.
That's a crucial point. When you talk about significant interpretations, what does that actually look like in practice? Is it usually a clear-cut difference, or is there a lot of gray area where management's judgment could lead to subtly different yet still material results?
It's rarely clear-cut, which is why it requires such close attention. An interpretation is deemed significant if adopting another reasonable interpretation would have produced a material difference in the presented information.
Material difference based on interpretation.
Okay. This means we're looking for areas where management's judgment had a tangible, significant impact on the numbers, and where alternative, equally valid judgments could lead to very different financial results.
Can you give an example?
Sure. A contract might have ambiguous language around when certain milestones are considered achieved for revenue recognition. Management makes a judgment. If a different, equally reasonable interpretation of that milestone definition would materially alter the reported revenue, that's a significant interpretation.
Got it. So it's about judgment calls.
Exactly. The crucial insight here is this isn't just about finding errors. It's about uncovering areas where management's judgment calls could fundamentally shift the financial narrative for the users, potentially altering the very purpose of the financial statements. That's a different kind of audit risk compared to a standard misstatement.
Our sources also point out that even if a contract stipulates a threshold below which misstatements will not be corrected, like a de minimis amount in the contract,
Right.
this does not relieve the auditor from determining materiality for planning and performing the audit in accordance with SA 320, materiality in planning and performing an audit.
Absolutely correct.
So while the contract might say, we don't care about misstatements under X amount, the auditor still has their professional duty to apply materiality based on the overall financial statements and the needs of their users.
Absolutely. The auditor's responsibility for materiality is independent of any contractual clauses, as it's a fundamental principle of auditing.
What about communicating with governance?
Good point. We also need to consider communication with those charged with governance, or TCWG. Be aware that the persons responsible for the oversight of special purpose framework financial statements may not be the same as those for general purpose financial statements.
So it might not be the usual board audit committee.
It might not. In a contractual setting, for example, TCW might be a small steering committee or even just the legal department of the contracting parties, rather than a full board of directors. This requires adapting your communication strategy to ensure the right people who hold the governance responsibility for these specific statements are informed.
And it's not just the core essays that apply, right? Others are relevant too.
Definitely. Other standards on auditing like SA 570 revised on going concern, SA 701 on key audit matters, and SA 720 revised on other information are also relevant and may require adaptation or specific application in an SA 800 audit.
How so? Like chems, for example.
For example, SA 701, key audit matters, which identifies the most significant matters in an audit, only applies to SPFs if required by law or regulation, or if the auditor otherwise determines it appropriate.
So it's not automatic like for listed companies?
Correct. It's not an automatic inclusion as it might be for a listed entity's general-purpose financials. This underscores that every aspect must be considered in the context of the SPF.
Okay, moving to the critical phase of forming an opinion and reporting.
Yes, the culmination. The auditor applies the requirements of revised SA 700, forming an opinion and reporting on financial statements. This is where all the groundwork comes together in the auditor's report, articulating the audit findings and opinion.
And a key part of that report is the description of the applicable financial reporting framework.
Absolutely. The auditor's report must adequately refer to or describe the applicable special purpose framework. And if it's based on a contract, any significant interpretations of that contract, which we discussed earlier, must also be adequately described in the financial statements and specifically referred to in the auditor's report to provide full context to the users.
Full transparency there.
And the content of the auditor's report on special purpose financial statements has specific additional requirements beyond those for general purpose statements.
Like what?
The report must describe the purpose for which the financial statements are prepared and, if necessary, the intended users. This information can also be referred to in a specific note within the financial statements to enhance clarity.
Purpose and users again, front and center in the report.
Always. And if management had a choice of financial reporting framework, say between two different contractual bases, the management's responsibility section of the report must explicitly refer to management's responsibility for determining that the chosen framework is acceptable in the circumstances.
Okay, holding management accountable for the choice.
This highlights that the auditor is not only verifying the application of the framework, but also ensuring management exercise due diligence in selecting an appropriate one in the first place.
Now, this brings us to a really critical element for preventing misunderstandings, and one that's probably a frequent point of examination.
The emphasis of matter paragraph.
Exactly, the EOM paragraph.
Yes, this is crucial. The auditor's report must include an EOM paragraph to alert users that the financial statements are prepared in accordance with a special purpose framework.
And why does this matter so much? Why is it mandatory?
Well, it's critical because special purpose financial statements may be used for purposes other than their original intention. For example, a regulator might require certain entities to place these special purpose financial statements on public record.
Right, and someone might stumble upon them without context.
Precisely. If someone then accesses them without understanding their unique purpose, it could lead to profound misunderstandings and inappropriate decision-making. So the content of this EOM must explicitly state that the financial statements may not be suitable for another purpose.
A clear warning label.
That's a good way to put it. It's a vital protection for the users.
And sometimes it goes further, right? Restricting
Right.
distribution.
Yes. In addition to this mandatory alert, the auditor may consider it appropriate to indicate that the report is intended solely for specific users, thereby restricting its distribution or use. This adds an extra layer of protection against misuse and helps manage the auditor's liability by clearly defining the scope of their responsibility.
This is where the exam prep really comes alive. Imagine a scenario where CA Lakshmi drafts a report for XLTD and YLTD based on a contract, say, for a joint venture's profit-sharing calculation.
Okay.
The question is, how does she ensure this report isn't misused for, say, a bank loan application?
Right. How does she ring fence it?
Our source provides a perfect example draft of this essential paragraph. It reads, "Basis of accounting and restriction on distribution and use. Without modifying our opinion, we draw attention to Note A to the financial statements, which describes the basis of accounting. The financial statements are prepared to assist the company to comply with the financial reporting provisions of the contract referred to above. As a result, the financial statements may not be suitable for another purpose. Our report is intended solely for XLTD and YLTD and should not be distributed to or used by parties other than XLTD and YLTD."
That wording is key.
The answer is precisely in this kind of emphasis of matter paragraph, making it abundantly clear who the report is for and what its limitations are. This is a very practical and legally significant application of the standard.
Exactly. This highlights the auditor's proactive role in managing user expectations and preventing misinterpretations or inappropriate reliance on the financial statements.
And other reporting stuff might apply too, like going concern.
Yes. Other reporting considerations for special purpose frameworks may also address going concern, key audit matters, if applicable, as we discussed, and other information, adapting the relevant SA 700 series reporting requirements as needed.
So the goal is always clarity.
The overarching goal for the auditor in an SA-800 engagement is clarity, context, and a precise alignment of the financial statements with their specific purpose and users.
Okay, that covers SA-800 really well. Now let's move on to SA-805. Special considerations audits of single financial statements and specific elements, accounts, or items of a financial statement.
Right, getting more granular now.
This standard deals with audits that are even more focused, potentially, than SA-800, focusing on isolated pieces of financial information.
That's right. When defining what we mean here, a single financial statement refers to an audit of a complete financial statement, but not a complete set of financial statements.
Okay, examples.
For example, you might audit just a cash flow statement, a balance sheet, or a statement of revenues and expenses in isolation. It's a full, self-contained financial statement, but only one of them.
So it's a full, standalone statement, but only one piece of the entire financial puzzle, not the whole book. Got it.
Correct. Then there's an element of a financial statement, or simply an element. This means an audit of a specific account or item within financial statements.
Like just receivables or inventory.
Common examples include trade receivables, inventory balances, cash and bank balances, a particular line item like property, plant, and equipment, or even a detailed schedule of disbursements related to a lease property. These are often subsets of a larger financial statement.
And for both a single financial statement and a specific element, it's important to remember that they include related notes.
Yes, always.
Comprising a summary of significant accounting policies and other explanatory information relevant to that statement or element. So even if you're auditing just trade receivables, it's not just a number.
No, it needs context.
It includes the accounting policies around revenue recognition and credit losses, providing essential context.
Crucially, these single financial statements or specific elements can be prepared in accordance with either a general purpose or a special purpose framework.
Ah, so SPF can apply here too.
Yes. And if prepared in accordance with a special purpose framework, SA-800 also applies to the audit.
Okay, so you could have both SA-800 and 805 applying.
Absolutely. This means an audit could fall under the purview of both SA-800 and SA-805 simultaneously, like in the CAM Surya example cited in our sources, where he audited trade receivables prepared under a specific contractual arrangement. You'd have the rules for the element and for the special purpose framework in play.
Double the fun. And the objective of SA-805, similar to SA-800, no opinion on controls.
Correct. Is to address special considerations in engagement acceptance, planning, and performance, and forming an opinion and reporting, but not for expressing an opinion on the effectiveness of the entity's internal control. It's always about the financial information itself, not the controls over it.
Let's delve into the considerations when accepting an SA-805 engagement. This is where practicality often clashes with the desire to perform an audit.
Yes, this is a big one.
And it highlights a significant challenge for auditors.
Indeed. SA-200. Overall objectives of the independent auditor and the conduct of an audit in accordance with standards on auditing requires compliance with all relevant SAs, and this applies whether or not the auditor is also engaged to audit the entity's complete set of financial statements.
Right.
But here's where it gets really interesting and often difficult. If you're not auditing the complete set of financial statements, performing an audit of just a single statement or element might not be practicable.
That's fascinating. Why would auditing just one element be impractical, especially if it seems like a smaller scope? What makes it so challenging?
It's a profound challenge because you won't have the same depth of understanding of the entity, its environment, or its internal controls. You lack that broader context that usually comes with a full audit.
Okay, lack of context.
Without understanding the interconnectedness of accounts, the overall control environment, or the general quality of the entity's accounting records, you'll often need far more extensive evidence to corroborate what you find in the accounting records for that single element.
So you need more work for the smaller piece.
Potentially, yes. For example, to audit trade receivables reliably, you might need to understand the entire revenue cycle, sales controls, and credit policies, which would typically be covered in a full audit. If you don't have that, your procedures for just receivables could become disproportionately time-consuming and expensive.
Right, I see. It could snowball.
It really could. This is a real-world challenge. Imagine CAG being offered to audit just trade payables while another auditor handles the main financial statements. Our source material highlights that this would be practically difficult.
Why difficult?
It's not just about auditing the numbers. It's about understanding the context, the controls, the overall picture. You wouldn't have the same insights into the general quality of accounting records or other information. So you'd need to explain why that broader understanding is crucial. and how it might necessitate more extensive and often disproportionate procedures for just one element to gain sufficient, appropriate audit evidence.
So the effort might outweigh the benefit.
The sheer effort for a small element might make the engagement not practicable or economically feasible, making it a critical engagement acceptance decision.
Beyond practicability, the acceptability of the financial reporting framework is also key, just like in SA 800.
Yes, it is. The framework must result in a presentation that provides adequate disclosures for intended users to understand the information conveyed in that single statement or element and the effect of material transactions and events. It's about ensuring clarity and completeness for the specific user of that limited information.
And you also have to think about the form of opinion.
Right. The auditor must consider whether the expected form of opinion, for example, presents fairly versus prepared in all material respects is appropriate, given the applicable financial reporting framework and local acceptance. This determines how you articulate your conclusion on that specific statement or element, ensuring the language aligns with the nature of the information being presented.
Okay. Once accepted, the auditor moves to planning and performing the audit. Here, adapting the general standards on auditing is crucial.
Very crucial.
As the scope is so narrow.
That's right. All SAs relevant to the audit must be adapted as necessary to fit the specific scope. Even standards on auditing like SA 240 on fraud, SA 550 on related parties, and SA 570 on going concern.
Even those apply to just one element.
In principle, yes, they are relevant because misstatements in a single element can arise from these broader areas. For example, an overstatement of trade receivables could be due to fraudulent revenue recognition schemes. Or the collectability of those receivables could be directly impacted by the entity's going concern issues if its customers are struggling. So even if you're only looking at one piece, you still have to consider the big picture risks that could affect that piece.
So even if you're only looking at one piece, you still have to consider the big picture risks that could affect that piece. It's not a complete isolation of that single element from the entity's overall context.
Precisely. It's interconnected.
What if you are doing the full audit as well?
If conducting this audit in conjunction with a complete set audit, evidence obtained from the complete set can, of course, be used efficiently. Save some work there. But the auditor must still plan and perform the audit of the single statement or element to obtain sufficient appropriate audit evidence for the specific opinion on that statement or element. You can't just rely solely on the full audit. The element needs its own direct and sufficient scrutiny to support a separate opinion.
And materiality might be different, lower.
Yes, that's a key point. The materiality determined for a single financial statement or element may be lower than for the complete set.
Why does that matter?
It directly impacts the nature, timing, and extent of audit procedures and the evaluation of uncorrected misstatements. A misstatement that might be immaterial to the complete financial statements could be highly material to a single line item, say cash and bank balances, if that's the only item being audited. This means your audit procedures need to be more sensitive to smaller misstatements.
More focused, tighter net.
Okay.
Now, let's move to forming an opinion and reporting, which holds some of the most complex nuances in SA 805 and is a very common area for exam questions.
Right, this is where it gets interesting. First, if the auditor undertakes an engagement to report on a single financial statement or element in conjunction with an engagement to audit the entity's complete set of financial statements.
So doing both?
Yes. The auditor must express a separate opinion for each engagement. They are distinct, legally separate engagements, and their opinions reflect that. 2 reports, 2 opinions.
And if the audited single financial statement or element is published with the complete set, like in an annual report,
then the auditor must ensure it is sufficiently differentiated to avoid confusion. You wouldn't want someone to mistake an opinion on just the balance sheet for an opinion on the entire financial performance and position. The distinction must be crystal clear to the user.
Okay, clear labeling. Now, the really tricky part.
Yes. The implications of the opinion on the complete set. This is a crucial distinction that frequently causes confusion and is a key aha moment for understanding SA 805.
So what if the main audit report has an adverse opinion or a disclaimer?
Okay. If the auditor expresses an adverse opinion or disclaims an opinion on the complete set of financial statements as a whole, they shall not express an unmodified opinion on a single financial statement, for example. Just the balance sheet that forms a major portion of those financial statements.
Why not?
Because such an unmodified opinion would contradict the adverse or disclaimer opinion on the complete set. It just doesn't make sense logically. This applies even if the reports are not published together.
even if separate?
Yes, because a single financial statement, like a balance sheet or a statement of profit and loss, is generally considered a major part of the whole, and its reliability is intrinsically tied to the overall financial picture.
So if the overall financial picture is, to use our analogy, a completely broken down car, you can't just pick out a major piece of it, like the entire engine, and say it's perfectly fine.
Exactly.
It just doesn't make sense logically if that engine is central to the car's function and the overall assessment is dire. It's fundamentally contradictory.
Precisely. However,
Mm-hmm.
and this is a significant nuance that often trips up candidates,
Okay, here we go. The exception.
an auditor can express an unmodified opinion on a specific element of those financial statements, for example, trade receivables, even if an adverse or disclaimer opinion was issued on the complete set,
Even with an adverse on the whole thing. How?
provided all these conditions are met.
Okay, conditions. That's a really interesting nuance. So essentially, you're saying it's about the pervasiveness of the problem in the full statements.
It's a core insight.
If the issue is contained, a clean opinion on a specific element might still be valid, but what are the biggest risks an auditor faces if they misjudge that pervasiveness? And what are those specific conditions?
You've hit on the core insight. Pervasiveness is key. The conditions are: 1, law or regulation does not prohibit it. 2, the opinion on the element is not published together with the adverse or disclaimer report on the complete set. Keep them separate. 3, the specific element does not constitute a major portion of the complete set. This is critical. Trade receivables, for instance, are usually not a major portion in the way a full balance sheet is. And 4, the specific element is not pervasively affected by the matter leading to the adverse or disclaimer opinion on the complete set.
Not pervasively affected. Okay.
This raises an important question. If a company's overall financial statements are unreliable, how can any part of them be deemed reliable?
Yeah, seems contradictory again.
The standard allows for a nuanced view here. Consider a scenario where an auditor gave a disclaimer on the statement of profit and loss and cash flow due to lack of evidence for current operations, perhaps because the client's operational records were destroyed in a fire.
Okay, specific issue.
However, the state of affairs, the balance sheet and its specific elements like property, plant, and equipment, or trade receivables, could still be considered fairly presented and adequately supported by pre-fire records, external confirmations, or other means.
So the balance sheet stuff might be okay even if P&L is shot.
Potentially. In such a specific scenario, where the adverse or disclaimer opinion applies only to certain aspects or time periods of the financial statements but not to the element in question, then an unmodified opinion on a specific balance sheet element like trade receivables might be justifiable.
What's the risk for the auditor, though?
The risk for the auditor lies in misjudging that pervasiveness. If the issues are truly widespread and affect almost every part of the financial statements, then an unmodified opinion on any element, even a small one, would be misleading. It requires careful judgment to ensure the specific element truly stands alone in terms of its reliability and doesn't contradict the overarching message of the full audit report.
So it's not a blanket rule. You have to consider the specific nature and pervasiveness of the issue affecting the complete set before giving a clean opinion on a piece of it.
Exactly.
It requires careful judgment and a deep dive into the why behind the overall opinion and ensuring that component isn't misleading in isolation. That's a really fine line to walk.
Exactly. It takes real professional skepticism and judgment.
What about other modifications in the main report, like a qualified opinion or an EOM?
Right. If the complete set audit report includes a qualified opinion, an emphasis of matter, other matter paragraph, material uncertainty related to going concern, key audit matters, or an uncorrected material misstatement of other information, the auditor must consider their implications for the single statement or element audit.
Do they have to mention it in the element report?
Even if there are no direct implications for the element itself, the auditor may deem it appropriate to refer to the matter in an other matter paragraph in the single statement or element report to aid users' understanding. This is about ensuring transparency and providing necessary context.
Okay, providing context.
And of course, it's crucial that the single financial statement or element, including related notes, provides adequate disclosures to enable intended users to understand the information conveyed and the effect of material transactions and events specific to that element. Disclosures are always key.
All right, let's transition to our third specialized audit area, SA 810, Engagements to Report on Summary Financial Statements.
Okay, the condensed version.
This standard deals with a very specific type of financial information that you often see in annual reports, investor presentations, or even regulatory filings, when a full, detailed set of financial statements isn't required or practical for initial consumption.
Exactly. What are summary financial statements?
Yeah.
These are historical financial information derived from financial statements,
Yeah.
but they contain less detail than the full financial statements.
Less detail, but still structured.
Yes. Despite having less detail, these still provide a structured representation consistent with the full financial statements. They're designed to give an overview without overwhelming the user with granularity.
Think of our earlier analogy of a movie. A full financial statement is the entire film with every scene, every line of dialogue, and all the character development. What then would a summary financial statement be in that context?
Good one. In that analogy, a summary financial statement is like a movie trailer versus the full film.
God, the trailer. Okay.
The trailer gives you the essence, the highlights, the key plot points, but doesn't have all the details. It's derived from the full film, consistent with its plot and characters, but it's clearly not the entire movie.
Makes sense.
That's what a summary financial statement is to a full set of financial statements. It's a highly condensed version encompassing summarized versions of the balance sheet, profit and loss, cash flows, and equity statements, but with significantly less detail in the line items and notes.
And this is different from a single financial statement that we discussed under SA 805.
Critically different.
Which is a complete statement like a cash flow statement, but not a full set. A summary financial statement under SA 810 is a condensed version of the entire financial statements, meaning it touches on all main statements but with less detail.
Yes, exactly.
This distinction is very important for exam purposes. SA 805 is a complete single statement, while SA 810 is a condensed version of the full set.
This distinction is paramount. So how does an auditor approach accepting an engagement for summary financial statements? There's a fundamental non-negotiable requirement here.
Okay, what's the big rule for acceptance in SA 810?
This is a fundamental principle. The auditor shall ordinarily accept an engagement to report on summary financial statements only when they have also been engaged to conduct an audit in accordance with SAYs of the financial statements from which the summary financial statements are derived.
Okay, so the same auditor usually has to do both the full audit and the summary audit.
Ordinarily, yes. That's a standard.
That's a critical point. Why is this specific requirement so fundamental in SA 810, unlike other standards? What's the core principle behind it?
The core principle behind this is quite simple. The audit of the full financial statements provides the necessary knowledge and understanding for the auditor to responsibly report on the summary.
Because they already know the details.
Exactly. Without that foundational understanding of the complete set, without having performed the in-depth work to assess balances, transactions, and disclosures, assessing the consistency and fairness of a summary becomes incredibly challenging, bordering on impossible for a responsible audit.
Right. How can you summarize what you haven't read?
Precisely. How can you confidently attest that a condensed version is a fair summary or consistent if you haven't thoroughly examined the original full document? It's like being asked to write a concise synopsis of a complex novel you've never read. You need to know the entire book to distill its essence accurately and reliably.
That makes perfect sense. You need to understand the source material thoroughly before you can confidently vouch for its condensed version. But you mentioned ordinarily. Is there any exception to this where another auditor might be allowed to audit the summary?
Yes, but it's a very specific and rare exception. In some cases, law or regulation might require an auditor to report on summary financial statements, even if they haven't audited the underlying full financial statements.
Like regulatory filings again.
For example, specific prospectus requirements under certain SEBI regulations in India might mandate this. In such very specific instances, the auditor's report on the summary financial statements shall not indicate that the engagement was conducted in accordance with SA 810.
Because it doesn't meet the core principle.
Correct. This is because it doesn't meet the core principle of the standard that the same auditor should have done the full audit. It's a statutory requirement, not a standard audit engagement in the SA 810 sense.
Okay. Before acceptance, the auditor must also determine if the criteria applied by management in preparing the summary financial statements are acceptable.
Yes, just like in SA 800, acceptable criteria.
This is crucial because, by their nature, summary financial statements inherently carry an increased risk of being misleading due to their aggregated and limited disclosure nature.
Especially if the criteria aren't clear.
Especially when no established criteria exist for their preparation. How does an auditor assess this acceptability?
The factors affecting this acceptability include the nature of the entity, the purpose of the summary financial statements, the information needs of the intended users, and critically, whether the applied criteria will result in summary financial statements that are not misleading in the circumstances,
Not misleading, that's the goal.
and criteria established by an authorized standard-setting organization or by law regulation are generally presumed acceptable because they are public, transparent, and developed with due process.
Easier if it's an established rule.
Much easier. However, if management develops the criteria themselves, for example, based on internal guidelines or industry practice not formalized by a body, the auditor needs to exercise far more caution and professional judgment to ensure these criteria are suitable and won't lead to a misleading summary.
More scrutiny needed then.
The increased risk demands greater scrutiny.
Beyond the criteria, the auditor must also obtain management's agreement and understanding of their responsibility for preparing the summary financial statements in accordance with the applied criteria.
Standard management rep stuff.
But also, management must agree to make the audited financial statements available to the intended users of the summary financial statements without undue difficulty.
Right. Access to the full details.
What does without undue difficulty practically entail? How easy does access need to be?
It's about ensuring easy access for the user. This could be via public record, providing clear instructions on where to obtain them, or establishing a process for ready access upon request. The goal is transparency. The summary is only valuable if the full context, the audited financial statements, is readily available.
Makes sense. And management has other agreements too.
Yes, and management must agree to include the auditor's report on the summary financial statements in any document that contains them and indicates the auditor has reported on them.
So they can't just use the auditor's name without the report.
Correct. This prevents management from using the auditor's name without providing the full context of the auditor's work. Finally, the auditor must agree with management on the expected form of opinion to be expressed on the summary financial statements.
And if things aren't acceptable?
If criteria are unacceptable or management refuses to agree to their responsibilities, the auditor shall not accept the engagement unless legally required, in which case, as mentioned, no reference to SA 810 compliance should be made.
Okay. Once accepted, what types of procedures does the auditor perform specifically for an SA 810 engagement? Given they've already audited the full financial statements, it seems like less work.
It's different work. The auditor performs various procedures to form an opinion on the summary financial statements. This includes evaluating whether the summary financial statements adequately disclose their summarized nature and identify the audited financial statements.
Making it clear it's a summary.
For instance, using a clear title, like Summary Financial Statements Prepared from the Audited Financial Statements for the Year Ended March 31st, 20XX. And must also evaluate whether they clearly describe where the audited financial statements are available if not accompanied, or cite the specific law that specifies they need not be made available.
This means ensuring the summary doesn't pretend to be the full picture, and crucially, points users to where they can get the complete detailed information.
Exactly. It's about full transparency, even in condensation.
What else? Checking criteria.
Correct. The auditor also evaluates whether the summary financial statements adequately disclose the applied criteria used in their preparation. They compare the summary financial statements with the audited financial statements to determine if they are consistent.
Checking the numbers tie out.
Or can be recalculated from the related information in the audited statements. This ensures mathematical accuracy and consistency of the summary with its source, verifying that the condensation process was correct.
And checking it's not misleading overall.
Finally, yes. They evaluate whether the summary financial statements are prepared in accordance with the applied criteria and are not misleading, and whether the audited financial statements are available to intended users without undue difficulty. This last point reinforces the auditor's ongoing responsibility regarding access.
Turning to the form of opinion for summary financial statements. If an unmodified opinion is appropriate, what specific phrasing should the auditor use? There seem to be two main options.
That's right. For an unmodified opinion on summary financial statements, the auditor's opinion shall use one of these phrases. The summary financial statements are consistent in all material respects with the audited financial statements in accordance with the applied criteria.
Consistent. Got it.
This phrasing is often used for a compliance framework, where the focus is on adherence to specific rules. Alternatively, the summary financial statements are a fair summary of the audited financial statements in accordance with the applied criteria.
Fair summary.
It is often used for a fair presentation framework implying a more qualitative judgment on the overall representation.
And if the law requires different wording?
If law or regulation prescribes different wording, the auditor must comply, but also evaluate if additional explanation is needed to mitigate misunderstanding. If not, they should not accept the engagement unless legally required, which would again mean no reference to SA 810 compliance.
The auditor's report on summary financial statements also has specific elements. Besides the clear title indicating it as an independent auditor's report on summary financial statements and an addressee, there's a crucial statement that must be included to manage user expectations.
Yes, a very important warning. The report must state that the summary financial statements do not contain all the disclosures required by the framework of the audited financial statements.
Okay, stating the obvious limitation.
And that reading the summary financial statements and the auditor's report thereon, therefore, is not a substitute for reading the audited financial statements and the auditor's report thereon.
Cannot stress that enough.
This is critical for managing user expectations and preventing them from relying on condensed information for decisions that require full detail. It's a bold and essential disclaimer.
This is a prime exam point, just like our CA Mathurs scenario, where the summary report was dated a month after the main report. You need to remember that explicit statement about subsequent events.
Yes, the timing difference. If the summary financial statements report is dated later than the audited financial statements report, it must state that the summary and audited financial statements do not reflect the effects of events that occurred subsequent to the date of the audited financial statements report.
So it's a snapshot from the original audit date.
Exactly.
Yeah.
This prevents users from mistakenly assuming the summary is an updated version of the full financials. It freezes the information at the date of the full audit.
Got it. And the report also details responsibilities.
Yes, it details management's responsibility for preparing the summary financial statements and the auditor's responsibility for expressing an opinion on consistency or fair summary based on SA 810 procedures. And, of course, it includes the auditor's signature, the date of the report, and the place of signature.
Now, let's look at what happens if there are modifications to the opinion, emphasis of matter, or other matter paragraphs in the audited financial statements, the main report.
Right. How does that flow through?
This is where it gets really nuanced and requires careful communication.
Okay. If the auditor's report on the audited financial statements contains a qualified opinion, an emphasis of matter paragraph, an other matter paragraph, a material uncertainty related to going concern section, communication of key audit matters, or a statement describing an uncorrected material misstatement of other information. A whole list of potential issues.
Wait, lots of possibilities.
But the auditor is satisfied that the summary financial statements are consistent in all material respects or are a fair summary of the audited financial statements in accordance with the applied criteria.
So if the underlying full financials have a caveat or extra information, but the summary itself still seems like a fair summary of those qualified or emphasized financials, what then?
It sounds like a careful translation of complexity.
Yeah.
Exactly. The summary report shall state that the main report includes such a matter. For example, a qualified opinion due to scope limitation or disagreement with management regarding a specific accounting treatment.
Okay, point it out clearly.
It shall describe the basis for that matter, e.g. basis for qualified opinion, and its effect, if any, on the summary financial statements.
So explain the why and the impact on the summary.
Yes. This implies a careful translation of the main report's nuances into the summary report. You're not just noting the modification, you're explaining its root cause and whether it impacts the summary, helping the user bridge the information gap. The goal is to ensure the user of the summary is not misled by the condensation and understands that the underlying full statements have an issue.
This directly addresses a key exam scenario. If the main report has a qualified opinion, you don't just ignore it in the summary report. You have to explicitly bring it up, explain why, and clarify its impact on the summary.
Absolutely. It's all about transparency and making sure the user isn't misled by the condensed information. It requires a lot of precision.
Now, for the most critical scenario, and this is a fundamental distinction from SA 805, where a clean opinion on an element was sometimes possible.
Right, the big one.
What if the audited financial statements received an adverse opinion or a disclaimer of opinion?
Okay, the really bad outcomes for the full audit.
If the full set of financial statements is deemed so unreliable as to warrant an adverse or disclaimer opinion, what happens to the summary? Can you give an opinion on a summary derived from fundamentally flawed statements?
The answer is a resounding no.
No opinion possible.
Correct. If the audited financial statements received an adverse opinion, meaning they are not presented fairly, or a disclaimer of opinion, meaning the auditor could not obtain sufficient appropriate audit evidence, the summary report shall state this fact and describe the basis for that adverse or disclaimer opinion.
Okay, state the bad news.
And here's the crucial part. The summary report shall also state that, as a result of the adverse opinion or disclaimer of opinion on the audited financial statements, it is inappropriate to express an opinion on the summary financial statements.
Inappropriate to express an opinion, full stop.
Full stop.
So if the foundation is rotten, you literally can't build a reliable summary on it, let alone express an opinion on it.
Exactly.
That's a clear do not pass go signal for expressing an opinion on the summary financials. There's no opinion to be given on the summary if the source material is fundamentally flawed to that extent.
Precisely. This is a fundamental distinction from SA 805. If the full set of financial statements is deemed unreliable to the extent of an adverse or disclaimer opinion, it logically follows that a condensed version of those same statements cannot be relied upon either. An opinion on the summary in such a scenario would be fundamentally misleading and would essentially negate the very purpose of an audit opinion.
And that ties into one of the theoretical questions.
Yes, this aligns perfectly with theoretical question 4 from our source material. An adverse opinion on audited financial statements directly leads to the inappropriate to express an opinion conclusion on the summary. It's a non-starter.
Okay. Beyond these core opinion implications, there are other reporting considerations in SA 810. What about comparatives?
Good question. If audited financial statements contain comparatives but summary statements do not, the auditor must determine if this omission is reasonable and its potential effect on the report.
And if another auditor did the comparatives?
If another auditor reported on comparatives, SA 710, comparative information, corresponding figures, and comparative financial statements, requirements apply. You have to follow those rules.
What about extra unaudited info presented with the summary?
If unaudited supplementary information is presented with summary financial statements, it must be clearly differentiated from the audited summary information.
Clearly labeled as unaudited.
Yes. If management refuses to differentiate, the auditor must state in the report that this information is not covered by their report. This prevents the auditor from being associated with information they haven't audited, maintaining clarity and integrity.
And finally, protecting the Auditors Association.
Right. The auditor must take steps to prevent management from inappropriately associating them with the summary financial statements if management does not include the related auditor's report in documents referring to the auditor.
So if management mentions the audit, they have to include the report.
Essentially, yes. This is about protecting the auditor's reputation and ensuring their work is presented accurately and with all necessary context. It's about controlling the narrative around their professional opinion.
All right, let's bring all this knowledge together with a scenario straight out of an exam to really solidify your understanding.
Okay, time for a case study application.
We have an abridged balance sheet and an abridged revenue account for two funds, Smart Investment Equity and Debt Fund, and Smart Investment Equity Savings Fund as of March 31st, 20XX. The abridged financial statements have been prepared by the Board of Trustees pursuant to SEBI regulations and in a prescribed format.
Okay, hearing abridged, pursuant to SEBI regulations and prescribed format.
What does that immediately tell you?
This is a classic example of summary financial statements. So immediately, your mind should go to SA 810. The fact that they're prepared under SEBI regulations means we likely have established criteria for their preparation, which significantly simplifies the acceptability of criteria assessment, making them presumed acceptable. This is a crucial starting point for any analysis.
Exactly. Established criteria under law makes that part easier. Now, let's tackle some exam-style questions based on this scenario, focusing on the specific language and principles we've just discussed, reinforcing how you'd apply them.
Let's do it.
Scenario question 1. What is the most appropriate title for the auditor's report on these abridged financial statements? You might see options like Independent Auditor's Report, Auditor's Report on Abridged Financial Statements, or Independent Auditor's Report on Summary Financial Statements.
Okay, thinking about precision and the standards terminology.
Which one fits best?
It's not a full financial statement audit, nor is it a single element audit under SA 805. It's specifically a report on summary financial statements derived from a full audit. Therefore, the most appropriate title, aligning perfectly with SA 810's requirement for clear identification, would be Independent Auditor's Report on Summary Financial Statements.
Clear and specific. Got it.
This immediately conveys the nature and scope of the audit.
Scenario question 2. Which statement should be included in the auditor's report regarding the use of these abridged financial statements, given their condensed nature?
This goes back directly to our earlier discussion about alerting users and ensuring the summary is not misused. SA 810 mandates a clear disclosure to manage user expectations.
So what's the required warning?
The correct statement directly mirrors SA 810's core disclosure requirement. It should be stated in auditor's report that reading the abridged financial statements is not a substitute for reading the audited financial statements of the schemes of the fund.
Can't rely on the summary alone.
Precisely. This ensures users understand the limitations of the condensed information and where to find the comprehensive details.
Scenario question 3. Which paragraph is most appropriate for the auditor's responsibility section in this report?
Okay, defining the scope and standards applied. This is critical because it's unique for summary financials.
So what should it say?
The correct option emphasizes expressing an opinion on the abridged financial statements based on procedures conducted in accordance with SEBI regulations and standards on auditing, adapted in circumstances, including SA 810.
Why mention adapted in circumstances?
The mention of adapted in circumstances reinforces the nuance of specialized audits, acknowledging that while core SAs apply, specific adjustments are made for the nature of summary financials and the specific regulatory context, like SEBI. It's just you understand it's not a standard SA application.
Okay. Scenario question 4. Which paragraph is most appropriate for the opinions section of this report, assuming an unmodified opinion?
All right, the final conclusion. What's the right wording?
Based on SA 810.
The correct option typically states, in our opinion, the abridged financial statements are a fair summary of those financial statements and are in accordance with the accounting policies and standards specified in SEBI regulations and generally accepted accounting principles in India to the extent applicable.
So, fair summary is the key phrase here.
Yes, fair summary is the precise phrasing from SA 810 for an unmodified opinion on summary financial statements prepared under a fair presentation framework, which GAAP implies. It's combined with the specific governing criteria, which in this case are SEBI regulations and generally accepted accounting principles. It's about combining the standard language with the unique context of the engagement and applied criteria.
This case study truly brings together the theory of SA 810, showing how the definitions, acceptance criteria, procedures, and reporting elements all interlink in a practical exam setting.
Absolutely.
Mastering these scenarios means you're not just memorizing, you're applying your understanding to specific facts and truly grasping the nuances.
We've navigated the intricate pathways of specialized audits today, from the bespoke nature of special-purpose frameworks under SA 800, which cater to specific user needs and require careful consideration of their purpose and intended audience.
Right, the custom maps.
To the specific considerations when auditing a single financial statement or element with SA 805, where practicability and the precise impact of pervasive issues on the complete set are paramount.
The engine versus the whole car analogy.
And finally, to the unique responsibilities involved in reporting on summary financial statements under SA 810, which fundamentally requires the auditor to have also audited the underlying full financial statements to provide a reliable opinion on the summary.
The movie trailer rule.
And the crucial no opinion rule in case of adverse or disclaimer opinions on the full set.
Hard stop.
The core takeaway is that while the overarching standards on auditing apply, these specialized engagements demand a keen understanding of purpose, users, framework acceptability, and the highly nuanced implications for reporting.
You now have a powerful roadmap, loaded with the specific language and nuanced applications, to confidently approach exam questions related to these critical says. Remember, it's not just about knowing the rules.
No, it's deeper.
But understanding why they exist and how they're applied in diverse financial scenarios. Whether it's a contract-driven audit, a specific account balance, or a condensed financial overview, these standards protect both the users of financial information and the integrity of the audit profession.
Indeed. And looking forward, as the financial world continues to evolve with increasingly tailored information needs and ever-present data overload, how might these specialized auditing standards adapt further?
Good question.
How can they continue to ensure clarity, relevance, and trust in financial reporting, even in its most condensed or purpose-specific forms? The dynamic nature of information demands equally dynamic and precise auditing standards.
Something to ponder as you continue your own deep dive into knowledge. Thanks for joining us for this crucial deep dive.
Hope it was helpful.
We hope it helps you ace that exam and truly master these concepts.